Good morning. Welcome to a brand new week of Trading Hour. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Hormuz Fatakia, and the bulls are continuing with their dominance. So it's a positive start to the week. The Nifty is up 123 points. Benchmark indices higher by close to about 0.5%. So in the last 15 minutes, we've given up a bit of ground. So we were closer to 24,500, just moderated a tad bit, but still holding up pretty smartly. Look at the way we've bounced back from our April low of 21,700, 21,800, it's been a rally of more than 12%. And now we're less than 7% away from our all-time high levels of 26,277. Mid-caps are charging ahead. The mid-cap index is a gain of more than 1%. The advanced decline ratio is positive. And while banks are dragging their feet on account of Kotak Mahindra Bank and State Bank of India to some extent, auto, FMCG, IT, metals, Reliance Industries, all these indices are up nearly 1% on an average. And then you've got so many individual mid-caps which deserve mention. So whether it's CDSL, a NetWeb, RR Kabel on the back of the numbers.
One player taking a step back and the others are stepping in to offset the pressure that is being created by the banks. Of course, the Nifty, well, the bigger question is whether these gains will sustain, as has not been the case over the last 3 trading sessions. We've come off the highs every single time we've tried making new highs. Of course, last Friday's high of 24,589 will be the important one, the important level on the upside to watch out for on the index. And of course, can't not talk about earnings reactions. Reema was just highlighting a few of them, and Jindal Saw is another earnings reaction as well. That too is down 6%, the top loser on the Nifty 500 index. And of course, on the upside, NetWeb, as Reema just mentioned, 16% higher now on NetWeb Technologies, and RR Kabel is now trading with gains of around 13.5%. So the top 2 gainers on the Nifty 500 are earnings reactions on the positive side. But of course, another earnings reaction on the positive side is Marico, and Mangalam is here to tell us how that fared in the 4th quarter. Mangalam.
Well, for Marico, the street was prepared for a decent set of numbers coming in on the revenue and the volume front, but the street's gone ahead and been positively surprised by the company. So if you look at it, the revenue that the street was working with was close to 2665 crores. They've gone ahead and reported 2730 crores on the top line with volumes at 7%, which is higher than all the other FMCG companies that have reported their numbers so far. The EBITDA at an absolute level has been in line with expectations, but because there has been a revenue beat on the margins, there has been a slight disappointment versus street expectations, but nothing really to worry about because the net profit too at an absolute level is in line with expectations. What stood out for the company this time around is the fact that their outlook is also fairly strong. They are expecting double-digit growth momentum to continue in FY26 with a double-digit growth in the operating profit led in the second half of this year. Their premium personal care, digital brands as well as foods business is likely to grow a lot higher, and because of which the share of foods and premium personal care will cross 25% of the overall revenue of the company in FY27, and they are expecting better margins to accrue from these verticals, so that will diversify their portfolio away from commoditized business. The other part that the street is cheering this time around for Marico is the reappointment of Saugata Gupta as the MD and CEO for a period of 2 years, starting from FY26 all the way up to March 2028. All these factors working positively for Marico. That stock higher in today's trading session.
Thank you very much for that, and we'll bring you our conversation with the management of Marico on their Q4 earnings today at 12:05. So stay tuned for that conversation. But moving on, RR Kabel is the other big mover today. The company reported their highest ever revenue in Q4 and FY25. Vamakshi is here with the details and what the management had to say in their interview with us.
Well, absolutely, Reema. When you look at RR Kabel, it's a very strong growth that the company has posted this time around. When you look at the revenue, that is up almost 29% on a year-on-year basis. A very strong beat coming out there. As far as the margins are concerned, they too have improved by almost 224 basis points to 8.83%. And the net profit too has seen an uptick of almost 64%. As far as volume growth is concerned for the entire year, that came in slightly softer than what the management had guided for. Volume growth stood at 7.1%, but going forward, they're guiding for nearly 18% volume growth. EBIT margin too came in slightly lower, 7.4% as compared to the guidance of 8%. Now keep in mind, let's also look at the segment-wise performance. Wires and cables saw a good uptick of almost 28%. They saw very good demand out here, which the management management also alluded to, and they also foresee good demand going into the future as well. FMEG revenue also saw an uptick of almost 13%. As far as the margin performance is concerned, margins for wire and cable improved from 8.7 to 9.9%, and that is mainly on account of better realization and operational efficiency. While for the FMEG business, the EBIT loss was lower from 19 crores that we saw in the same quarter last year to around 9 crores this time around. And in fact, the management has guided that the FMEG business will break even in the first half of FY26. So that bodes well for the company. Other than that, they've also announced capacity expansion plans at Waghodia, Gujarat, which is where they will be making an investment of around 1,050 crores. As far as the Silvassa unit is concerned, they will be adding further capacity for which the investment stands at around 400 crores. Largely, it will be a mix of internal accruals as well as that, and the management has said around 1,200 crores of new capex investments will be done, and apart from that, nearly 200 or 300 crores odd would be financed largely through term loans. So overall, a good set of numbers, good commentary coming in from the management. Resultantly, the stock is trading higher.
The stock is trading higher, of course, and as Vamakshi was mentioning, right, the capex plans is what has buoyed the street, because at a time when competition is increasing, Ultratech, Adani, all of them foraying in, RR Kabul is going in, and all right, doesn't matter, we're going to increase capacity and we'll take the competition head on, and that is what is cheering. The street is cheering, of course, 13.5% higher on RR Kabul, from one top gainer to the other, and that is Netweb Technologies is the other one. Vinny is here to tell us how did that company fare in the quarter gone by. Vinny.
A good performance that has come in from the company in Q4 FY25, a beat in terms of the revenue front for the company. Margins was a slight bit of a miss versus what analysts were highlighting, but overall the performance has been very good in terms of order book, also pipeline. The analysts were quite happy with it. The street was happy with it as well. They met their full year guidance. That said around 1,000 crore revenue guidance is what they'd given for FY25, so it's about that. 100 crores in terms of profits, that is about that as well. So 100 crores is beat, 1,000 crores is beat in terms of revenue. Overall, order book is seeing a bit of a dip on a sequential basis, mainly due to higher conversions. But other than that, FY25, the AI segment for the company, that has seen a sharp growth coming in. 15% of the revenue comes in from AI versus just around 11% in FY24. And overall, analysts are quite positive on this one, though we'll wait out for the con call highlights that will come in today afternoon. So that will be key to watch out for there in terms of further guidance for FY26.
Thank you very much for that. And CDSL reported a miss in revenue while the net profit beat estimates due to higher other income. Vamakshi joins in with the numbers.
Well, a weak set coming in from CDSL. It's a miss, like you said, on revenue as well as operational profitability in the fourth quarter. Revenue saw a downtick of almost 19% sequentially. The margins too have contracted by around 900 basis points, and largely this pressure is coming from higher computer tech expenses. Computer tech expenses saw a growth of almost 14%. Keep in mind, the net profit though saw a decline of nearly 23% sequentially, despite the kind of spike that we saw in the other income, which was up nearly 57%. As far as particular segments are concerned, the revenue has declined for the depository activity, which is down nearly 17.8%. Data entry and storage too saw a very sharp knock of almost 25% sequentially. But on the flip side, when you look at the repository business in terms of revenue growth, that has done well, up nearly 15% sequentially. Let's also look at the margins. The repository business has reported an EBIT loss, but when we look at the depository activity, the margins out here has declined by almost 1,100 basis points. Data entry and storage too is seeing a decline of nearly 900 basis points as far as margins are concerned. Let's also look at the operational performance. It was rather weak. CDSL's net account opened in the quarter was only 64 lakh. This is much slower as compared to the previous quarter, wherein we saw 92 lakh new accounts getting added. The demat custody in terms of rupees lakh crore also saw a downtick of almost 5%, now standing in at only 71 lakh crore. Number of issuers, on the other hand, is seeing an uptick of 14%. ISINs also are up nearly 7.4%. But overall, when we look at the operational as well as the numbers, rather weak set, the stock is resultantly tanking in trade.
4% lower on CDSL. So earnings reactions on both sides of the spectrum coming in. But moving aside of earnings reactions, of course, the other pocket that is the talk of today is the oil sensitives, be it the oil marketing companies, be it aviation stocks, paint stocks, all of them doing well today after the Brent crude prices fell below $60 a barrel earlier in the day. HPCL is up 6.5% now, ahead of its results tomorrow, and similar reactions also seen in BPCL, which is up 4.5%. Also stocks like Interglobe Aviation, which is also trading with gains of around 4% in today's trading session. A fall in crude oil prices beneficial for all of these companies. On the flip side though, it's not good news for stocks like ONGC and Oil India, as they result in a loss of around 200 to 300 crore annually for every $1 per barrel fall that the crude oil prices see. So there's some recovery from the lows of the day, but still trading in the red. Take a short break. On the other side, discuss market technicals with Somil Mehta of Mirae Asset Share Khan, and also discuss his top trading ideas. Stay tuned. Welcome back. Around 24,500 is the index, continues to remain at those levels, 140 points higher. It'll be interesting to see if these gains sustain as the day goes by. But Somil Mehta from Mirae Asset Share Khan is joining in for a quick chart check and some trading ideas as well. Somil, good morning. Thank you for joining in. How important is that 24,600 mark on the upside? We've tried making multiple attempts to cross that. We've not managed to do so. So how important is that level? What's your call on the index and your stock specific ideas as well?
Sure. As you mentioned, that 24,600 has been very crucial resistance in the last couple of weeks actually. The entire fall which we've seen from 26,200, 300 levels, the highs, and the low of 21,700, 21,800 levels, the entire fall retracement of 61% is exactly at 24,550, 600 levels. So this zone of 24,600 or 24,500 will remain a very crucial resistance, a very crucial hurdle. Once we close above that, I think the next level should be much higher. 25,100 would be the next level to watch out for. So medium term still remains positive. However, in the very short term, I think the markets will remain range bound between 24,200 and 24,600. That will be the range I'm expecting. Probably it will go on for another 1 week, and then we'll break out on the upside. Medium term still remains positive. I would like to stay with the large caps and the defensives when picking stocks. My first pick would be from pharma space, that is Lupin. Lupin is consolidating in a very small range. A small triangle pattern is being forming, and it has taken support at 200 daily exponential moving average, and now it is breaking on the upside. I'll be expecting a very good short-term up move for a target of 2,200, and the stop loss would be 2,050. The second stock which I have chosen is Asian Paints, again a large cap stock, a defensive play, again a small consolidation which is expected to break on the upside. Today we have seen a good start for the week. I'll be expecting a target of 2,650 and a stop loss of 2,390 for Asian Paints. My third pick would be from the mid cap space, a smaller space, a short-term trend for this stock, Aarti Industries. Again, a triangle pattern already broken on the upside. We've seen a very good up move today. I'll be expecting still the up move to continue for a stop loss of 429 and a target of 470.
Got that. Thank you very much for that. We will slip into a very short break. We'll come back and get chatting with more managements and get you a check on the market. Stay tuned. Welcome back. Let's talk about the big banks. Kotak Mahindra Bank is down over 5% following the Q4 earnings. But now lots of the large banks are out with their numbers. So Abhishek now joins in with a report card on the large lenders and who did what. Abhishek.
Well, Rima, to begin with, large lenders have reported their Q4 FY25 performance. And if you take a look, at the comparison table, private banks have seen robust deposit growth on a sequential basis, anywhere between 5.5 to about 7% range. In fact, at a time, this has come in, at a time when deposit growth is a big concern in the industry. Seasonal in nature in Q4 for deposit growth to happen for SDFC Bank and Axis Bank. Now, SBI has seen the weakest deposit growth on a sequential basis at just 2.9% in Q4 FY25 amongst large banks. If you take a loan growth, and if you take a look at the loan mix, the corporate portfolio has actually been shunted down by private banks because of the unfavorable yields. That is what many managements have commented. So, the likes of ICICI Bank and Axis Bank and Kotak Mahindra Bank as well, they spoke that, unfavorable yields have led to a corporate book not growing that much. On the other hand, if you take a look, SBI's, corporate growth of 5.5%, that is corporate loan growth, has been one of the highest amongst all the large banks. Now, net interest margin has improved quarter on quarter for most of the banks, especially ICICI Bank and SDFC Bank. They have seen the highest sequential growth in their net interest margin. However, for SBI, it's actually shrunk by 1 basis point on a sequential basis. Now, operational efficiency was another area of focus. It's been the highest decline for SBI, their cost to income ratio declining by 184 basis point on a sequential basis. Axis Bank and Kotak Mahindra Bank actually saw an increase in their cost to income ratio. The meaningful part in any bank's result is the return ratios or ROA. So SBI saw a decline in its ROA, that is return on asset, on a sequential basis, while Axis Bank and ICICI Bank have seen the highest increase in their return on asset ratio on a sequential basis. If you take a look at the valuation picture with reference to price to book value, large banks like SDFC Bank, ICICI Bank on the private side trade between 2.7 to 2.9 times, while SBI is trading at 1.5 times price to book value on a 1 year forward basis. Back to you.
Indeed, so interesting comparisons there. Abhishek, thanks a lot for that. We'll take this conversation forward with Ruchit Mehta of SBI Mutual Fund, who is joining in now. Ruchit, good morning. Thank you for joining in. Sticking to what Abhishek was mentioning about the large private banks, what do you make of the numbers? Kotak is not seeing a very good reaction to its results, but HDFC Bank and ICICI Bank both surprised the street on the positive. So what's your call here on large private banks? Do you stick to the leaders? Do you find value in the smaller names?
I think traditionally we've been liking the larger private banks a lot better. I think even in the current environment that's there, we think that the private banks should see an improvement in their growth prospects. Particularly, I think from a margin standpoint, I think the private banks could do a little bit better than the public sector banks, given the way the pricing of the deposits and the loans would be. The public sector banks would likely see a bit more pressure on NIMs compared to what the private sector banks would do. So from a sectoral perspective, we like the banking space overall, but within that, I think the private banks could do better than the public sector banks. But even within the public sector banks, you have some of the larger names which kind of would do well going forward as well. We've not so positive about a lot of the tier 2 or tier 3 banking names. And there are a lot of individual challenges, be it with regards to overall growth prospects or in terms of management, quality, etc. So I think it's better off to stick to the larger names within the banking space overall.
Ruchit, you want to tell us the top picks in the larger banks? We've got a Kotak, SBI, if you add, the PSU heavyweight there, ICICI Bank, HDFC Bank, and Axis. Which one would you recommend now?
I wouldn't go name specific, but I think you can be more on the private sector and the larger public sector banks. Overall, we have been more positive on the banking sector per se. Growth has been fine. I think ROEs have been fine. The sector has underperformed over the last 3 years, and if you think of all of the matrices, the banks have been doing reasonably well. So I think this year they have seen a bit of an outperformance, and we think that they should continue to outperform the market overall.
The other big story, Ruchit, this morning has been oil, and it's been on the declines from almost around what, $75-80 at the start of April. We are now sub 60, and this has had a windfall for our own economy as well. But what about stocks in this oil sensitives basket? Where do you position yourself? You position yourselves among the OMCs, or you still believe that stocks like ONGC, Oil India will still recover from this? Or would you find other oil sensitives, say paints or tires or even aviation for that matter? Where do you place yourself?
I think in a falling oil environment, you obviously want to be with the companies which are going to be using oil as an input. So, as you mentioned about whether it's the paint sector or the aviation sector, more so because they will see probably lower cost and, may be able to expand their margins. But in terms of the oil companies per se, I think the oil marketing companies traditionally seem to have not seen material benefits either on the upside or on the downside when oil prices have moved. They should be able to report reasonably okay set of numbers. Some of the profit expansion right now that could occur because of the fall in oil prices could help them recover some of the losses that they made previously with regards to certain commodities like LPG, etc. So by and large, they should be okay. Players like ONGC, etc., will obviously see a decline in their earnings, considering that they are more directly sensitive to oil prices per se. So I think you're better off seeing the decline in oil prices to participate and look at investing into companies which are beneficiaries of the commodity rather than sort of the commodity producers themselves.
What else are you bullish on? I mean, if you had to construct a portfolio today, Ruchit, how would you go about doing that? What would your bias lie towards, and the sectors that you would avoid or themes?
So we've been positive on the financial sector per se.
You said that,
That's one area. The second is that anything to do with domestic consumption. I think in the current market environment, in a domestic place will do far better than any company or any sector that's more export oriented. Especially given the degree of uncertainty that's out there, right? If you are exporting to the US, right now there is a high degree of uncertainty whether you will have the ability to export or not, whether there's demand itself or not. So there's a lot of question marks on export-oriented names. So we've been a lot more cautious on that part of the market. I think you're better off being focused more on domestic-oriented names, particularly domestic consumption names, and more so on the domestic consumer discretionary side of it, right? And I think a variety of factors. You have modest, improving economic growth, some bit of early signs that perhaps the rural economy is doing a lot better. Income growth there has been fairly fine. You have these tax cuts which are now kicked in, so everybody is likely getting about anywhere from 90,000 or give or take on average as a tax cut that's there, and that likely could boost some of the domestic consumption that's there. So I think domestic consumer discretionary names per se look fine. I think some of the infrastructure names also look fine. I think sectors like cement, etc., they've faced a lot of input cost pressures. There has been some bit of demand weakness as well, but the sector started to consolidate quite a bit. You're seeing some bit of recovery in the demand. Government spending on capex has started to improve as well. So these are areas that could do well. Overall, infrastructure, capital goods, engineering, broadly they look fine. I think from a demand perspective, things look okay. Valuations are obviously expensive. They are factoring in a lot of growth that's there, and therefore one has to be cautious with regards to the mismatch between expectations versus what can actually be delivered by these companies.
All right, Ruchit, thank you so much for sparing time and joining us today. Looking forward to having you more often on the platform. That is Ruchit Mehta of SBI Mutual Fund. By the way, the Nifty slightly off the highs, now 120 points higher, now at 24,470. Take a short break. On the other side, we continue corporate conversations. Anand Agarwal, the CFO of V-Mart Retail, joins in to discuss the road ahead for the company. Stay tuned. Back and on to corporate conversations then. V-Mart Retail's fourth quarter revenue surged almost 17%. EBITDA was up 70% on a year-on-year basis. Meanwhile, the board has also announced a bonus issue of shares. To discuss this and a lot more, Anand Agarwal, the CFO of the company, is joining in on the show. Anand, good morning. Thank you for joining in. Now, how has sentiment been on ground? We are almost, 35 days into the first quarter of FY26, heading into another upcoming wedding season. How has sentiment looked on ground, and what are the kind of growth targets you are penciling in for FY26, be it on the revenue or the margin front?
Hi Vivek, good morning. And I think the sentiment on the ground remains positive. We are quite gung-ho on the underlying opportunity, and we keep building on more momentum as we move forward. Footfalls have been quite positive, and I think while Eid, some part of the festivities this year shifted into March, but otherwise the wedding season is quite strong, and the expectation of a good monsoon also lingers on. So thereby we are looking at a good quarter ahead. I'm not building in any misadventures right now, but I think at an overall level we are still looking at a good growth going ahead.
So Anand, X of any misadventures, what could same-store sales growth look like for FY26? And you want to break that up in first half, second half?
Difficult to break it down, Rima, but definitely looking at mid to high single-digit same-store sales growth as we have delivered in the past as well. So last quarter, in fact, was the 6th straight quarter of same-store sales growth. And looking forward also, I believe we should be able to continue with a similar kind of growth story.
Sorry, wasn't FY25 in 11% same-store sales growth?
Yeah, for the full year, it was 11%, but it also came at a slightly lower base of FY24. Okay. So on a larger base and on a much stronger network, it will be difficult to deliver a double digit, but we'll definitely try for high single or mid to high single digit.
What will drive that same-store sales growth, Anand? Would it be V-Mart? Would it be Unlimited? Or will it be a combination of both, or one leading and the other following?
I think it will be a good combination of both. Primarily what is happening is that we've been working a lot on our product, and we are trying to attract a much younger audience, much more youth, and that has been sort of working. And we've also worked a lot on our quality and on the replenishment side. So all of that is not happening only at one single brand level, it's happening at an entity level. And it's impacting the performance, and the benefits are accruing on both the brands. Apart from that, we're also doubling up on the expansion now that we have closed some of the unprofitable stores. So we're also looking at higher expansion, higher growth targets for all the old stores where we need to do some facelift or upgradation, etc. So combined impact of all of that should continue to give us better results, as we also see some amount of tailwinds coming from the rural sentiment. So if you recall, last 2-3 years had been slightly subdued as far as rural was concerned. And we are seeing better, footfalls, better conversions, and better interest coming in from all these sectors.
Okay. What's the outlook on margins? You've ended Q4, I believe, with margins of 8.7%. Now, given your expansion plans, the refurbishment, the new products that you're adding, what could margins look like in FY26? And if you could break that up in terms of retail and digital, because digital is still loss-making.
So I think we should continue to build on the margins. I think a large part of the margin should come in from the kind of same-store sales growth that we are able to get. But largely, I'm not looking at a lot of margin expansion. I'm looking more at a top-line growth with stable margins. If at all there are margins expansion, I think it will come at the back of slightly higher like-to-like sales growth. But otherwise, we would want to, as a value retailer, want to give back to the customers as much as we can to drive higher volumes and grow more on rupee margins rather than percentage margins. So that's been our philosophy, and we will continue to build on that as well.
What about store additions, Anand? You had mentioned at the end of your fourth quarter update that you're expecting to add around 60 to 65 in FY26. How would you break that up between V-Mart and Unlimited?
So roughly 20% of that should come in South India under Unlimited, and the balance should come in V-Mart. While we remain quite optimistic on expanding the Southern India, expansion slightly higher, but the constraint around finding the right locations at the right cost remains a bit challenging. But otherwise, I think at an overall level, we should still look at around 12 to 13% net area addition, which should translate to around 60 to 65 net stores for the next year.
That's similar to what you did last year. I think last year was also 62. And this year also you're guiding for about 60 to 65 new addition in terms of store. Sorry, just getting back to the point about margins. You're saying margins will be stable, but the outlook on digital, where you're still making losses, what's the company planning to do about that?
I think the digital losses have consistently been coming down by almost 50% every year for the last 2 years. And we continue to look at that side of the business more as a omni enabler rather than a cost center. So basically what is going to happen is that the LimeRoad part of the digital part of the business will continue to invest in new technologies in upgrading the customer experience at an overall level. While not really expanding so much the loss-making e-marketplace business. So as a result, we should continue to look at the losses coming down by again 50% in this current fiscal. In any case, this business is around 1% of the total business, so it's not a material number, and even the losses there are very, very immaterial now.
That's true.
So profitability still far off in this fiscal, Anand. So maybe by FY27.
So in the digital place, we are not looking at profitability in this year, but at an overall level, we have been profitable this year, and we should also be profitable next year. So I think that LimeRoad is a very, very small, insignificant, but important and critical part of the overall business.
What's your average price point of the apparel now, and how would it compare with what it was, say, last year or 2 years back? Just curious.
So average selling price for apparel is around 300 rupees. It's slightly higher in South India and slightly lower in North India. But otherwise, the pricing has remained stable. There have been around 2% reduction versus last year, but mostly due to mix variations. But otherwise, from a pricing perspective, we have not taken any price hikes or price reductions.
What about inventory days? Anand, one final question from my end. From around about 132 in September of 23, you came down to 92 in December, slightly higher at 102 in March. What do you expect to go on this trend? Where does this go?
I think on a moving average basis, we are happy with around 90 days of inventory. Currently at March end, we had slightly upstocked our inventory in preparation for the upcoming, the summer season as well as the wedding season, and also for the new stores that we plan to open. So in fact, we opened around 7 stores in the last 1 month itself. So today we stand at almost 503 stores. So we've been building up on that part as well. But otherwise, on the inventory front, we remain very comfortable. The inventory is very healthy. In fact, our inventory provisioning actually came down last year by almost 50 basis points. So that is a reflection of the health of the inventory. So we're quite happy with the inventory that we hold.
Thank you very much, Anand, for joining in, and look forward to more conversations with you as we begin this new fiscal year. That's the management guiding for mid to high single-digit same-store sales growth, lower than the 11% that they clocked in last year. Margins will remain stable. The stock is down 7.5%. Get into a break. On the other side, Dheeraj Singh, CEO of SIS, will join in to talk about the company's Q4 results.
Welcome back. The next management on the show is SIS after their fourth quarter results, which were largely in line with expectations. Revenue was up 9%. Margins also remain flat. To discuss the company's performance in the quarter gone by, Dheeraj Singh, the CEO of the company, is joining in on the show as of now. Dheeraj, good morning. Thank you for joining in. Undeniably, I think growth has slowed down, right? You grew 11% in FY20, almost 13% in FY23, 8% in 24, now 7.5%. What do you attribute that to, one, and what is the kind of growth that you are penciling in FY26? Do you expect this to return to double digits?
Absolutely. I think the focus for the group had been on the margin side. And if you see our margin percentage, that has consistently been improving over the past 4 quarters. So we had weeded out a lot of the lower margin contracts. We had focused on the kind of new contracts that we are taking. That had some impact on our revenue growth. But now that we've cleaned up to a large extent many of the older contracts, we do stick by our earlier guidance of about 14 to 15% CAGR over the next few years, which is what we've maintained. If you look at the past 7-8 years since IPO also, our CAGR both on EBITDA and revenue has been about 14 to 15%.
No, fair enough. While your long-term CAGR is 14-15%, but that's boosted by extraordinary growth seen in the earlier years when your top line was half of what it is right now. So I'm looking at FY18, your top line was 5,800 crore. That year you grew 33%. The following year it was 21%, but now you're a much larger company. So, and last 2 years it's been a high single-digit kind of a top-line growth. Just for the near term, FY26, could you give us an indication of the kind of growth? Will it be double-digit? And two, on margins, can you get back to 6% EBITDA margins for the India security business now that you weeded out some of the less profitable contracts?
So I'll answer your question in three parts. On the overall base, yes, we have a very large base now. But in terms of market share, security market share is only about 7 to 8% right now. As a market leader in Australia, our market share is 22%. While the overall market grows, our market share has enough scope to grow further. Our facility management business, though it is now the largest in pure facility management services, we are clocking 200 crores per month. But there we are only 4% of the market share. So there's ample opportunity in both our main business segments. In terms of the revenue growth for the FY26, yes, I'll be very comfortable in giving the mid double-digit percent growth. But
Dheeraj, sorry, we'll have to cut you in. The numbers of Mahindra & Mahindra flashing on your screens now. Net profit of 2437 crores compared to a poll of 2450. So in line with expectations, the revenue too higher than what the CNBC-TV18 poll was anticipating at 31,353 crores. Poll was at 3137. So revenues higher than expectations. The net profit too in line with what the CNBC-TV18 poll was indicating. So on the looks of it, at least it's a revenue beat for Mahindra & Mahindra for this time around. We'll see more on the margins front as to how the numbers have shaped up. So we'll await more details on that. But for now, the net profit figure at 2437 in line with expectations, and the revenue at 31,353 is also higher than what the poll was expecting. And so Mahindra & Mahindra, of course, has been one of the outperformers in this year for the Nifty, at least ahead of the results. The stock is always down 4%, but ahead of its results too, the stock has zoomed up almost 20% in the last 1 month. So that is what Mahindra & Mahindra has done so far ahead of its results. We'll get you more details as they emerge for now, and we can get more details on the EBITDA and margin front. There you can see the EBITDA at 4683 crores compared to the CNBC-TV18 poll of 1458. We'll get more clarity on that, and the margins too. We'll see how they have shaped up. Of course, clarity will be also awaited on their SUVs business as to how that has fared, the tractor business, how that has fared, and the road ahead for the tractor business as well. So they remain the SUV market share, as I can see from their press release, as at 22.5% in at the end of FY25. The tractors business too, the highest ever full year market share at 43.3%. So the stock too recovering after that initial dip that it had seen after the numbers, and is surging back towards the highs of the day. So, and at least prima facie, Reema, the numbers look good on the screen.
Oh, indeed. And it's been reporting such robust volume growth numbers, right? Quarter after quarter. I think in the quarter of Q1, the total volume growth was up 19% year on year. Break that up, you've got auto volumes up 18% and tractor volumes up 23%. So both engines for M&M have been doing very well, auto and tractor. And plus now for the tractor season, you are getting into the monsoon. Monsoon hopefully will be normal. The income tax cuts will boost spending. So that could be a benefit for perhaps, tractor sales. So the street has been very bullish on M&M. And now again, I remember even Q3 was a good quarter in line with expectations. And Mahindra & Mahindra has delivered on street expectations even in Q4. It's turned out to be a good quarter, a beat on the revenue, a beat on the margins too. EBITDA, particularly significantly higher at 46,803, higher than the CNBC-TV18 poll of, I think, about 44,100 crores. So big beat on margins. Let's get in Prakash Diwan. He joins us on the show. Prakash, M&M has already had a good rally. It's outperformed many of its peers. Give us your initial take on these numbers.
So, Rima, to be honest, it has rallied, but it is still off its highs given the fear that people had with the Tesla and BYD possibilities of coming into India and all. But these numbers tell you that their leadership in SUVs, leadership in even the farm equipment is absolutely unchallenged. And the electric vehicle portfolio will only add to the salience and growth. So very, very positive on this. Even the new acquisition, the SML Isuzu acquisition is extremely positive for them. So I think it's a company that's on a roll. The business is matured enough. They've done whatever it takes to kind of streamline, and plug gaps where they used to be. So very, very well placed. And these numbers tell you that they have the ability to go against the tide and increase market share, increase margins. So that's really commendable.
Prakash, tractor volumes too in the fourth quarter have risen 23%.
Yeah.
And even on and heading into the monsoons as well. So with SUVs firing, heading into a monsoon, so things seem to be falling into place right now for M&M, isn't it?
Oh, absolutely. So, generally there is an expectation that farm equipment sales pick up only, monsoon and post-monsoon. But, what has happened is there's a shift in market share. If you realize a lot of the MNC players have actually not been doing very well on the distribution side. There are lots of dealerships that have got rationalized. And Scotch Kubota has moved itself into a different trajectory category. So their portfolio mix is going through a bit of an evolution. And I would believe till the Japanese get their way, are able to establish what they want to focus on, that's the time where when they blink, Mahindra has actually taken market share. So I was anticipating this, and I think going forward, even the EV side of the portfolio will contribute very significantly. So that's another vector that we have not yet penciled in. So hopefully it will probably make its new highs, which it came down from. It came down drastically because of the Tesla news, but I think it's correcting itself in a very positive way.
It came down drastically, I remember, underperforming, but it's climbed back up. It's still about 9% lower from its record high levels, but that's largely even where the market is. Even the Nifty is down about 6-7% from its all-time high levels. But Prakash, one final question. And the question is, can you buy Mahindra & Mahindra at this price?
Oh, certainly. Okay. And as I said, you just have, as Ormus also pointed out, the farm equipment peak season is yet to come. And if they've already seen growth there, that means, they're doing something right in terms of clawing back market share. And the SUV segment is something where a lot of the models that came in from competition have actually all kind of stabilized. So there's nothing new that's coming. Whereas these people have the EV portfolio and the Thar variants and all of that will keep them in the running. So definitely, I wouldn't be surprised they'll probably outperform the market. Being a Nifty stock, it's important that money comes into the allocations start coming in vis-a-vis some of the other names, and that will actually take away a lot of the slack which is there.
All right, Prakash, thank you so much for sparing time and joining us today to decode the numbers of M&M. A strong beat coming in there, 39% higher the EBITDA on a year-on-year basis. Margins to expanding 150 bips from last year. The company has also announced a dividend of around 25 rupees a share for its shareholders. So a strong quarter for Mahindra & Mahindra. The stock remaining around 1.25% higher. Of course, mind you, it has surged around 20% before the earnings announcements over the last month or so. Take a short break. On the other side, we bring you more on the markets. Stay tuned.
Welcome back. What's changed in the last 30 minutes is that the banks are coming off now. Profit booking is setting in. The Nifty Bank is now nearly 500 points, 450 points from the day's high. And look at the fall in the last 30 minutes or so. And that's dragging the Nifty too. The Nifty had opened around 24,500 an hour back, and now it's closer to 24,425 in the green, but off from the session highs. And that brings us to a close in this edition of Trading Hour. From the entire team, thank you for watching.